Welcome to the Pro Ticker Deep Dive.
Good to be back.
There is this distinct, almost physical feeling of whiplash in the markets this week.
Oh, absolutely.
If you logged off, say, Wednesday afternoon, you had a very specific narrative locked in your head. The Federal Reserve sits on its hands, rates hold steady, and you get the standard, carefully curated, data-dependent boilerplate.
Right. It felt managed.
It felt predictable.
It felt like the calm before the storm, in retrospect. I mean, Wednesday was the soft landing narrative, basically on cruise control. The market was comfortable.
And then Friday morning hit, today, January 30th. It feels like the economic data gods looked at that smooth sailing narrative and, well, decided to throw a brick through the window.
That's a good way to put it.
We have a massive amount to get through because this morning's inflation report, it didn't just miss expectations. It fundamentally challenges the assumption that the inflation fight is in the rearview mirror.
It absolutely does. It shifts the entire calculus from, when is the next cut to did we maybe cut too much too soon? And it did that in the span of about 4 hours. The bond market is having a really tough time digesting this today.
So here's the mission for this deep dive. We need to reconstruct this week to understand where we are heading. We have to dissect this hot producer price index print from this morning.
And not just the headline number.
No, not at all. I mean, the ugly details inside the services sector. Then we need to re-examine the central bank's decision to hold rates earlier this week in light of this new data.
And you cannot ignore the political theater. I mean, it's just everywhere. You've got a Supreme Court battle over the bank's independence and then a new nominee, Kevin Warsh, waiting in the wings.
It's a total convergence of policy, politics, and prices.
Exactly.
So let's start with that Friday shocker, the producer price index for December 2025. I mean, the market was lulled into this false sense of security, expecting a quiet, 0.2% rise?
That was the consensus, yeah. We got a wake-up call. The headline, PPI rose 0.5% month over month. That's, more than double the forecast.
More than double.
But for anyone listening, the headline is often just noise. You have to look at the core stripping out food and energy. That's where the real signal is. And the signal was flashing red. Core PPI jumped 0.7% in a single month.
0.7%. I mean, if you annualize that run rate, you're talking over 8%. That is not cooling.
No.
That's reacceleration. That's the kind of number we saw back when this whole inflation crisis first started.
Exactly. And that pushes the year-over-year core rate up to 3.3%.
Yeah.
But the most critical part of this report, and the part that has bond traders, sweating today, is where the inflation is coming from. For the last year, the story has been goods deflation, services inflation.
Right. The thesis was that goods prices come down as supply chains heal, and we just sort of wait for services to finally crack.
The problem is services aren't cracking. In fact, they're
getting stronger.
They're expanding. Goods prices were flat in this report. Diesel fuel collapsed down almost 15%. So the inputs for moving physical stuff actually got cheaper. But the cost of services rose 0.7%.
And if you dig into the tables, there's one line item that is doing some incredibly heavy lifting. I saw this in the notes and it jumped out at me immediately. Margins for machinery and equipment wholesaling.
That's the one. It surged 4.5%.
Let's pause on that because that sounds really esoteric, but it's actually a window into corporate psychology, isn't it? When we say margins for wholesaling, we're talking about the middleman's cut.
Precisely. This is not the factory raising the price of the steel or the microchip. This is the intermediary, the entity that sits between the producer and the end user, deciding that they have the pricing power to expand their profit margin.
Which implies demand is just strong enough to absorb it. You don't raise your margins by 4.5% in a weak economy. You do it when your customers are desperate for the equipment and, flush with cash.
That is the key insight. This isn't a supply shock, it's a demand signal. It tells us that businesses are still investing, they're still buying machinery, and they are willing to pay a premium to get it.
And it wasn't just machinery.
No, not at all. We saw spikes in residential natural gas, motor vehicles, soft drinks, and non-ferrous metals. Think copper? Aluminum surged 4.5%.
And copper is often called Dr. Copper because it has a PhD in economics. It predicts growth. If copper is surging alongside wholesaler margins, the industrial economy is not slowing down.
No, it's revving up.
It certainly doesn't look like a recession.
But here's why this specific report is just a nightmare for monetary policymakers. We know they don't target PPI explicitly. They target PCE, personal consumption expenditures.
Their favorite gauge. But the two are mechanically linked, right? You can't have one without the other eventually.
They are. There is a direct pass-through. Several components of the PPI, specifically around portfolio management fees and healthcare services, are fed directly into the formula for the PCE.
So when PPI services run this hot, it mathematically forces the PCE print higher.
It does.
Hmm.
We can effectively front-run their favorite gauge. We know the PCE is going to be hot later this month because we just saw the inputs today. The algorithm for the PCE is now baked in with higher numbers.
And this just destroys the narrative that the central bank could cut rates in March because inflation was under control.
Absolutely. You cannot justify easing financial conditions when the leading indicators for your primary metric are exploding higher.
Which brings us to the decision they made just 48 hours ago. Wednesday, January 28th. They held rates steady at 3.50% to 3.75%. At the time, it felt like a cautious pause. Now, looking at this data, it looks like a desperate necessity.
It looks like they dodged a bullet. I mean, imagine if they had cut rates on Wednesday and then this data came out on Friday.
Oh, they would have looked incompetent.
They'd have been pouring gasoline on a fire.
But let's look at their rationale on Wednesday. They've already cut 175 basis points since September 2024. That's a pretty significant easing cycle.
It is. And the argument was, look, we've done a lot. Policy acts with a lag. Let's see how the system digests that liquidity. But the backdrop for this decision is what's so fascinating. We are looking at Q4 GDP data that is expected to have a 5 handle.
Over 5% growth in an advanced economy that is supposedly cooling to fight inflation. That's unheard of. We usually only see that kind of growth coming out of a deep recession, not late in the cycle.
It creates a massive cognitive dissonance. Usually when you have 5% growth, the central bank is hiking rates to cool things down. Instead, they've been cutting.
This brings up the no landing scenario.
Right. We spent all of 2024 and 2025 debating soft landing versus hard landing. No landing just means the economy keeps flying at 30,000 feet, but inflation stays stuck at 3% or 4%.
And that kind of feels like where we are.
It does. The economy is ignoring the interest rates, and the policymakers know it. There was a very subtle but very critical shift in the language of their statement on Wednesday.
I noticed this too. The Fed watchers were just obsessing over the labor market paragraph.
Of course. Previously, the statement included a line saying that downside risks to employment had risen. That was their code for, we are scared people are going to lose their jobs, so we need to cut rates.
That was the justification for the last few cuts.
Yeah.
Sort of insurance against a recession.
On Wednesday, that line vanished. It was just gone. Instead, they said the labor market is showing signs of stabilization.
That is a pivot. They are essentially admitting the labor market isn't falling off a cliff. And if the labor market is stable and GDP is 5% and inflation is reaccelerating,
then the justification for rate cuts just evaporates. Their dual mandate is stable prices and maximum employment. If employment is maxed out and prices are unstable, their job is to fight prices.
which means higher for longer, or at least pause for longer.
The market is now pricing out the March cut entirely. And honestly, if this trend continues, we might have to start having the uncomfortable conversation about whether the next move is actually a hike.
Wow!
I don't think we are there yet, but the probability is non-zero.
That would be the ultimate plot twist. Now, normally we analyze the central bank as this, technocratic machine operating in a vacuum. But this week, the vacuum was broken. The political pressure cooker around the institution is just exploding.
It was a spectacle. We had the chair appearing at the Supreme Court on Monday and then wearing a purple tie to the press conference on Wednesday.
Let's deconstruct the purple tie moment. He explicitly said it was a symbol of bipartisanship, red mixed with blue. It felt a bit on the nose.
It was a valiant attempt at branding, let's say. He's trying to project this image of the bank as an island of stability above the political fray.
But the irony is just palpable.
It is. He's wearing a bipartisan tie while the president is literally in court trying to fire one of his governors.
The Lisa Cook case. This is historic.
It's the most significant challenge to the bank's independence in over a century. The chair called it the most important legal case in the Fed's 113-year history, and I don't think he's exaggerating. If the president wins the right to fire a governor at will, the institution becomes an arm of the Treasury. It loses its ability to make unpopular decisions, like keeping rates high to fight inflation.
And that creates a risk premium in the market. I mean, investors trust the currency because they trust the central bank isn't just printing money to help the incumbent win an election. If that trust breaks, the currency breaks.
And the drama didn't even stop there. You had the chair refusing to answer questions about a DOJ investigation into his own congressional testimony. It just feels like the institution is under siege from every angle.
And right in the middle of this siege, we get the announcement of the relief force, or maybe the replacement force. President Trump nominated Kevin Warsh to take the reins in May 2026.
The Warsh put, if you will.
Kevin Warsh is a known quantity. He was a governor during the '08 crisis. He's been a critic of recent policies. But the market reaction to his nomination was fascinating. We saw a rally.
We did, and on the surface, that's confusing. Warsh is considered a hawk. He is generally skeptical of QE and easy money, and usually stock markets hate hawks.
Right.
But in this specific context, with inflation spiking and the current leadership looking a bit, politically battered, the market views Warsh as the adult in the room.
It's a flight to competence.
Exactly. The market is saying, okay, inflation is scary. We want a guy in charge who is tough enough to kill it rather than someone who might let it linger. It signals that the regime change in May will be focused on price stability. It reduces the uncertainty of a runaway inflation spiral, even if it means rates stay high.
So we have a hawkish nominee, a hot PPI, and a paused Fed. Let's talk about how the capital markets digested this Friday's surprise. It wasn't just a straight sell-off. There was some nuance.
It was a day of aggressive rotation. We call it market whiplash. Equities dipped initially when the PPI hit the tape, algorithms reading the headline.
Yep.
But they clawed back. The resilience is remarkable.
But under the hood, what's happening?
Well, there is a Sell America trade developing.
I've been seeing this in the flow data. Capital moving out of U.S. large caps and into emerging markets.
It makes sense if you think about valuation gaps. The S&P 500 is priced for perfection, massive growth and low rates. Today showed us we might not get the low rates.
And emerging markets.
They've been beaten down. If the global economy is growing at 5% led by the U.S., that pulls up global trade, which benefits EM.
But the bond market, that was a bloodbath.
As it should be. The 10-year Treasury yield pushing toward 4.25%. Bond traders are realizing that the pivot is dead for now. And when yields rise like that, it breaks things elsewhere. Look at gold.
Yeah, gold fell below $5,000 an ounce. Psychologically, that's a big level to lose.
And it confuses retail investors. They think inflation up equals gold up. But for institutional money, it's real rates up equals gold down.
Because gold yields nothing. The opportunity cost argument.
Exactly. If I can get 4.25% risk-free in a treasury or 5% in a money market fund, the opportunity cost of holding a gold bar in a vault just went up. Gold needs falling real rates to shine. Today, real rates spiked because the market is pricing in a Fed that has to stay tighter for longer.
And silver took it on the chin even harder, down 16% at one point.
Silver is high beta gold. When the liquidity tide goes out, silver gets crushed. It's also an industrial metal, but the monetary tightening narrative just overwhelmed the industrial demand narrative today.
I also noticed the whole digital gold narrative took a hit. Bitcoin traded down, correlating more with the NASDAQ than with gold.
That correlation remains stubborn. When liquidity tightens, or the expectation of it tightens, risk assets get sold. Bitcoin is still trading like a high-growth tech stock, not a sovereign hedge. It followed the tech sector lower earlier in the week.
And speaking of tech, we had a divergence there too. Microsoft earnings disappointed, but then Apple posted its best iPhone sales quarter in 4 years.
Which just reinforces the consumer strength argument. People are still buying expensive hardware. That aligns with the 5% GDP. It contradicts the idea that the consumer is tapped out.
So, okay, let's pull all these threads together for the listener. We're in this bizarre economic moment. We have GDP growth that looks like a boom 5%. We have inflation that looks like it's overheating 3% plus $30. And yet, until 48 hours ago, the official line was that the economy was fragile.
It's the fragility paradox.
Is it actually fragile? Or is that just a narrative to justify lower rates?
I think the data is stripping away the fragile narrative. You don't have wholesalers expanding margins by 4.5% in a fragile economy. You don't have record iPhone sales in a fragile economy.
It feels more like an economy that's running too hot for its own good.
That is the danger. We're in the last mile of the inflation fight. Getting from 9% to 4% was, just about unblocking supply chains. Getting from 3.3% to 2.0%, that requires crushing demand. And right now, demand is not crushed. It's roaring.
So for the person listening, the CFO planning their capital expenditure, or the home buyer looking at mortgage rates, what is the big takeaway from this week?
The takeaway is patience is going to be expensive. If you are banking on a March rate cut to lower your floating rate debt or to refinance a mortgage, that door just slammed shut.
And the pass-through effect is real.
Oh, absolutely. If you run a business, that 0.7% service inflation is coming for your P&L. Your vendors are going to raise prices. If you're a consumer, those wholesale costs we saw today will be on retail tags in, what, 3 months? The deflationary period of goods might be ending.
It challenges the entire investment thesis of 2026. The consensus was slow growth, falling inflation, falling rates. The reality might be high growth, sticky inflation, steady rates.
And that requires a completely different portfolio. You want companies with pricing power, like the ones we saw in the PPI report, not companies that rely on cheap debt to survive.
One final thought before we wrap up. We talked about the 5% growth and the 3% inflation. If the policymakers are truly data-dependent and they see this acceleration, do they have the courage to actually hike rates in an election year? Or does the political storm we discussed, the Supreme Court, the threats, force them to stay on the sidelines and let inflation run hot?
That is the multi-trillion-dollar question. If they are paralyzed by politics, we could see inflation unanchor completely. They risk losing credibility entirely if they sit and watch prices spiral because they're afraid of the political fallout.
Which might be exactly why the market is cheering for Kevin Warsh. He doesn't seem like the type to get paralyzed.
Indeed, May 2026 can't come soon enough for some investors.
A fascinating week, and I have a feeling next week won't be any quieter. We'll be watching the PCE print like hawks when it finally drops. Thank you for tuning in. See you all in the next Pro Ticker Deep Dive.